what I would say is a caveat for what not to do. You know, the one thing that businesses require if they're going to succeed in developing emerging markets is the capacity to suffer as managers. The burden on income that comes about from developing a market. I mean, it's certainly something that Berkshire's talked a lot about as a competitive advantage for their businesses because you know, Warren is not at all dependent upon quarterly reported earnings to make a difference in his life. And the management within Berkshire know that. So if there's a business that offers a huge long-term return in Berkshire, they'll take it, even if it destroys short-term profits. That was at the heart of the finite risk transfer business that has long been part of the insurance company, bringing over books of business in return for the ability to manage those outcomes and invest the cash. Berkshire's freeing up the balance sheet of certain companies that are desperate, and they're able to take that on. Well, when they take that on, they have huge burdens to the reported profits that don't matter economically. Most public insurance companies would never do that because they're driven by smooth reported profits. Berkshire has made a tremendous amount of money over the years having the freedom from acting. With Geico, when they bought that, Geico only had 1.5 million policies when they bought it, and now it's 11 million. The reason why Geico couldn't grow is they couldn't absorb the income statement risk of the reported profit hurt caused by new accounts. When Berkshire did the equity index put option, they exposed themselves to the risk of a mark-to-market on equity movements globally. Over 8 quarters, they put through their income statement $13 billion worth of losses, which were the accounting impact of what happened to those puts. It doesn't matter. Warren had the $5 billion of premium. He's investing it, and in 12 or 15 years from the time he took that on, he had no worry that he'd actually have a financial underwater liability because the equity markets over time likely will go up. Nobody else took that insurance risk because they wouldn't risk the reported profit flows that came about and actually did burden Berkshire. The ability to suffer when building for the future is extraordinarily empowering because most people don't feel they have that ability. To do it, you really often are best served by having family-controlled companies. Cadbury Schweppes wasn't one. The business Berkshire is, and that's why they were able to accomplish so much. Brown-Forman, a company that I invested in the 1980s, was, and they've grown their Jack Daniels franchise around the world because of their capacity to absorb the starting losses to the point where today they have 25 markets with 100,000 cases. You really can't, you're not going to make much money in a market when you're building from 0 to 100,000 cases because the fixed costs of distribution and sales and all the efforts that you have to make are too high relative to the few thousands of cases that go through the system. From 100,000 plus, you're starting to accrue full margins for the next case sold. And you've developed a preference so that there's a penetration that's beginning to accelerate. And so you're going to, so from that point on, incremental volume is profitable. The benefit of increased penetration will drive more volumes, as will greater frequency. So you introduce someone to the product, they're part of the 100,000. But once they're a consumer, they will increase their frequency with the product as they have more money to spend. And in those developing emerging markets that they've set these toehold positions, it's that growth in consumer disposable income as a function of GDP that we really count on. And so Brown-Forman, as a spirits producer, a company we've owned shares in for a long time, family controlled as it is, was willing to make the investment that burdened income to the point where they're not today. You have 25 markets that have a very promising future because they've covered their fixed costs. That's the hand that you're supposed to play. And that was a hand that Cadbury was playing in China. They proved up the appeal of their chocolate, gum, and hard candy business in the 3 major cities. And about, 12 years ago, they embarked upon a program to take that success nationally. So they went to the next 200 cities, which as you know, in China might be, the smallest of those 200 cities may still have 1 million people in it. And within that same range, there are cities that are bigger than New York, 10 million plus, there are countless numbers of them. So they busily began to build the brand. Well, you can imagine what happens if you go into a city, 5 million people in the middle of the rural industrial part of China, and you announce yourself as having a product that the consumer is supposed to care about. Well, you've got to make it, you've got to advertise it, you have to distribute it, you have to sample it, you have to go back at it again and again and again. And it's all about an accelerating and deepening loss. Because when you open up 10, then you open up 40, then you open up 100 cities, and you, in the course of opening up a city, have smaller expenses that grow bigger, 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 compounding the rate of spend versus relatively anemic revenue up front versus the number of cities you spend in, you end up having quite a considerable burden to your income statement. And along that, and we celebrated it. We applauded management. We told them they're doing the right thing. They proved it up to the big cities, take it out to the small ones. You'll end up owning the market because there's no Western company there yet. You'll have a leader advantage, all the rest. Job well done, so we said. But another activist came along and bought 3% of the stock and demanded to have a meeting with management. And the week after that meeting, the management came out and said for strategic reasons, they thought it'd be a good idea to shut down those 200 emerging cities in China. Now, what they really did is they gave earnings per share back to the investor. In doing so, they destroyed net present value. Because as those losses mounted, they're in the 5th year and they have 200 cities. Now they're all activated and they're all running at losses, let's say. That's a point where the consumer has sampled, developed brand preference, is increasing its frequency, and there are more of them. And so the revenues, if they just could hold on, would more than begin to offset the costs. And you'd start to break into margins that would start to look more normal. And this journey of loss making to profitability will have concluded in a natural way. The only thing it needed was time. And the one thing that an activist doesn't value like we do is time. They knew that they could create earnings by stopping the investment spend at this late stage of that rollout. But now, now those brands are no longer present, and those consumers who are all prepared and trained to be consumers no longer have the ability to express that brand loyalty. It was short-term beneficial and long-term destructive, and that's what we try to avoid. Businesses where the short term has a higher preference than does the long term.